Module 11, Emerging Trends in Business Finance.
Globalization refers to the shift toward an integrated and interdependent world economy. Simply, globalization means the economies of different countries in the world, big and small, no longer operate as a separate national economy. Companies cross borders to operate overseas trading in both the commodities and financial markets take place between business people and investors across countries, and policies and trade agreements are created for mutual benefit. Globalization has two facets: globalization of markets and globalization of production. What is the globalization of markets? Historical, distinct, and separate national markets are merging. It no longer makes sense to talk about the German market or the American market. Instead, there is a global market. Falling trade barriers make it easier to sell globally. Consumers' taste and preference are converging on some global norm. Firms promote the trend by offering the same basic products worldwide. Globalization of markets. Benefits of globalization of markets: reduces markets costs, create new market opportunities to local buyers needs, global sustainability. The globalization of production refers to the sourcing of goods and services from locations around the globe to take advantage of national differences in the cost and quality of factors of production like land, labor, and capital. Companies compete more effectively by lowering their overall cost structure or improving the quality or functionality of their product offering. Globalization of production. Benefits of globalization of production: access lower cost workers, access technical expertise, access production inputs. Global corporation. A global corporation, also known as a global company, is coined from the base term global, which means all around the world. It makes sense to assume that a global company is a company that does business all over the world. There aren't many companies in the world that can boast of having a business presence in every major country. Actually, they probably can be numbered on the fingers of both hands. The global company definition therefore should be a little more lenient to accommodate this fact, which would enable more companies to all call themselves global companies. Companies go global for the following reason: to seek production efficiency, to avoid legal and trade restrictions, to expand markets, to seek raw materials and technologies, to protect processes and products, to diversity, to retain customers.
There are 5 factors that firms need to consider should they decided to go global. Number 1, different currency denomination. Firms that operate in several countries will face the challenge of streamlining the record of financial transaction as they will be in different currency. Number 2, political risk. Even domestic firms face risk. Number 3, economic and legal restrictions. Economic and legal restrictions in different countries can have an impact on a firm's policies and procedures. Number 4, role of governments. Some governments are more involved than others in the policy making of private-owned businesses. Number 5, language and cultural differences. Firms operating in different countries face the challenge of dealing with language barriers and cultural differences. Inflation rates, interest rates, and exchange rates. Inflation rates is the extent to which prices of commodities increase over time. Magkakaiba ang inflation rate sa mga bansa at alam dapat ng mga global firms na ang inflation rates ay makakaapekto sa interest at exchange rates. And all these three factors affects the global firms' revenue, cost structures, income, and cash flow. At ito naman yung dapat i-consider sa inflation rates. First is, currency of countries with higher inflation rates depreciate in values. Halimbawa, if the inflation rates in the Philippines is higher than the inflation rate in US, the Philippine peso value decrease. Halimbawa, may isang fast food chain na nasa Pilipinas, pero ang headquarter niya is sa US. Nag-purchase siya ng 20 kilos na chicken sa halagang $100 sa Pilipinas. Pero kung sa US siya magpo-purchase, hindi lamang 20 kilos ang mabibili niya sa halagang $100 dahil nga mababa ang value ng Philippine peso. Number 2, higher inflation rate also means higher interest rates and vice versa. Halimbawa, may business ka na nag-ooperate sa ibang bansa na may low inflation rates. Mas pipiliin mong manghiram sa mga bangko dun sa bansa na yon dahil mababa rin ang interest na ibibigay nila. Purchasing power parity or triple P. This is the idea that goods in one country will cost the same in another country once their exchange rate is applied. This theory which the exchange rate between currency are equal when their purchasing power is the same in each of two countries. Ang purpose nito ay para ma-compare ang isang product sa magkaibang bansa. Ang formula nito is purchasing power parity equals cost of good in currency 1 over cost of good in currency 2. For example, an American visits a particular market in India. The visitor bought 25 cupcakes for 250 rupees and noticed that cupcakes are quite cheaper in India. The visitor claimed that on average, 25 such cupcake cost $6. Ang given natin is 25 cupcakes. Ang cost niya ay 250 rupees. Tapos sa US dollar naman is $6, yung 25 cupcakes. Ginamitan na natin siya ng formula, purchasing power parity equals cost of 25 cupcakes in rupees, which is 250, over cost of 25 cupcakes in US dollars, which is 6. I-divide lang natin siya ng 250 divide 6. So, ang lalabas dun ay 41.67. Therefore, the purchasing power parity ratio of exchange of cupcakes in 1 US dollar is equal to 41.67 rupees. Behavioral finance. This is the study of the effects of psychology on investor and financial markets. It focuses on explaining why investors often appear to lack of self-control, act against their own best interests, and make decisions based on personal biases instead of facts. There are three biases that often affects how people behave or think when it comes to investment decision. First is overconfidence bias, second, self-attribution bias, and third is hindsight bias. Overconfidence is a well-established bias in which a person's subjective confidence in his or her judgment is reliable greater than the objective accuracy of those judgments, especially when confidence is relatively high. Overconfidence is one example of miscalibration of subjective probabilities. Self-attribution bias is a long-standing concept in psychology research and refers to individual general tendency to attribute successes to personal skills and failures to factor beyond their control. Hindsight bias, also known as the "knew it all along" phenomenon or creeping determinism, is the common tendency for people to perceive past events as having been more predictable than they actually were. Business analytics is the process by which businesses use statistical methods and technologies for analyzing historical data in order to gain new insight and improve strategic decision making. It is a data management solution, and business intelligence subsets refers to the use of methodologies such as data mining, predictive analytics, and statistical analysis in order to analyze and transform data into useful information, identify and anticipate trends and outcomes, and ultimately make smarter, data driven business decisions. Three types of business analytics. First is descriptive analytics, second is predictive analytics, and last is prescriptive analytics.
Descriptive, predictive, and prescriptive. Business analytics can reveal invaluable insights and information that ultimately lead to better decisions making and more successful business strategies. Descriptive analytics. Historical data is collected and organized to create data sets that can then be used to identify patterns and meaning. Predictive analytics. Business can use both current and historical data to make prediction about the future. Prescriptive analytics. Using all available data, the course of action that will best take advantage of opportunities or avert risks is determined. Descriptive analytics. Descriptive analytics is the process of using current and historical data to identify trends and relationships. It's sometimes called the simplest form of data analysis because it describes trends and relationships but doesn't dig deeper. Descriptive analytics is relatively accessible and likely something your organization uses daily. Basic statistical software such as Microsoft Excel or data visualization tools such as Google Charts and Tableau can help parse data, identify trends and relationships between variables, and visually display information. Descriptive analytics is especially useful for communicating change over time and uses trends as a springboard for further analysis to drive decision making.
Predictive analytics. Predictive analytics is the use of data, statistical algorithms, and machine learning techniques to identify the likelihood of future outcomes based on historical data. The goal is to go beyond knowing what happened to providing a best assessment of what will happen in the future. More and more organizations are turning to predictive analytics to increase their bottom line and competitive advantage due to growing volumes and types of data and more interest and using data to produce valuable insights. Faster, cheaper computers, easier to use software, tougher economic condition, and a need from competitive differentiation. Prescriptive analytics is the process of using data to determine an optimal course of action by considering all relevant factors. This type of analysis yields recommendation for next step. Because of this, perspective analytics is a valuable tool for data-driven decision making. For example, a manufacturing company could draw on more than company data. It called leverage, but historical and customer industry trends and predictions and general economic predictive analytics. The power of the cloud is pushing perspective analytics into new exciting possibilities every day. Importance of raw data. Whether it is descriptive, predictive, or prescriptive analytics, the fundamental issue is still the availability of quality data. Before firms can resort to the use of analytics, it is imperative to make sure that accurate, timely, and relevant raw data are available for processing. A cliché that most industry practitioners would often say about data is garbage in, garbage out. This means that if data that is made available to decision makers are of poor quality, then the decision made based on that data will also be of poor quality. Gartner's Business Analytics Framework. Gartner's framework shows the basic relationship between value and difficulty. The framework is simple in the sense that it shows how both value and difficulty increase as a firm evolves from descriptive through predictive then prescriptive. Note, however, that Gartner's framework added one type's diagnostic analytics. Additionally, the framework starts with just information, then it progresses of optimization as the firm moves of from descriptive all the way to prescriptive analytics. Financial windfall. As you have learned, people have different or varying beliefs and principles on how they manage money matters. As such, people's behavior will also vary when they receive a financial windfall or an inflow of money. This inflow of money may be unexpected. If it is expected, then what you receive was more than what you expected. An example would be an inheritance or a sale of a property. Another example is when you receive double the amount of your allowance because your birthday is approaching. In many cases, the source of the financial windfall is at some point immaterial as long as it is legal. What really matters is how you would behave and handle that money.